A commercial bank and a central bank both have the word bank in the name, and that is close to where the similarity ends. One of them wants you as a customer. The other one will never open an account for you, no matter how much money you bring. Here is the short answer. A commercial bank is a private, for-profit business that takes your deposits and lends that money back out. A central bank is a public institution that takes no retail customers at all. It banks the banks, sets the country's interest rate, and issues the actual currency. That is the short version. The reason it works that way is stranger than most people expect, because the central bank has been losing money for the better part of a year and nobody has shut it down. By the end of this, you will know exactly which one is holding your money, which one sets the rate you pay, and which one is allowed to keep operating while deep in the red. Start with the test that settles it fastest. Can you open an account there? You can walk into a commercial bank today and open one. Chase, Wells Fargo, your local community bank, any of the 278 insured banks and savings institutions the FDIC counted in the first quarter of 2026. They want your deposit. That is the raw material of the whole business. Now try that at the central bank. You cannot. There is no branch. No retail app, no account for you at any price. The Federal Reserve's customers are commercial banks, the federal government, and a handful of foreign central banks. That is the entire list. So the two never compete for the same customer. They sit on different floors of the same building. Your bank holds an account for you. The central bank holds an account for your bank. Those accounts are called reserves, and only banks are allowed to have them. Here is why that matters in practice. When you send money to someone at a different bank, your dollars do not travel anywhere. 2 reserve accounts at the central bank get adjusted instead. That is the plumbing under every payment you make. So who actually owns these places? A commercial bank is a business, and it is honest about that. It exists to make a profit for its shareholders. Those same 4,278 institutions earned $80.5 billion in a single quarter in early 2026. That is not a scandal, that is the job. Every fee, every rate spread, every product someone tries to sell you at the counter traces back to that one goal. A central bank has no such goal. The Federal Reserve is a public institution, and any surplus it earns is handed to the United States Treasury, not to shareholders. There is a detail here that gets twisted constantly online. So let me be precise about it. Member commercial banks do hold stock in their regional reserve bank. That sounds like ownership. It is not. The stock cannot be sold. It cannot be traded. It carries no control over policy. The dividend is fixed by law at 6% for smaller banks, and for banks above $10 billion in assets, it is the lesser of 6% or the 10-year Treasury yield. So it works more like a membership fee with a coupon attached than like owning a company. The truth is less dramatic than the version you see shared online. It is also far more useful. Now, where does the money itself come from? This is where most explanations go wrong, including the one you were probably taught in school. The classic story goes like this. You deposit $100, the bank keeps 10 in reserve and lends the other 90 out. Repeat that down the chain and the money multiplies. That story is out of date in the United States. In March 2020, the Federal Reserve cut reserve requirement ratios to 0%, effective the 26th of that month. Every depository institution, no requirement at all. It has not gone back since. So what actually creates money? Commercial banks do, and they do it by lending. When your bank approves a mortgage, it does not go hunting for someone else's savings to hand you. It writes the loan on one side of its books and creates a brand new deposit on the other. That deposit is money that did not exist that morning. Most of the money in the economy, including the balance sitting in your banking app right now, was created in exactly that way. The central bank creates a different kind of money, physical currency, and those reserve accounts. That layer is called base money, and everything else settles on top of it. 2 kinds of money made by 2 different institutions. Look closer, and one of them sets the price of the other. When the news says the Fed raised rates or cut rates, here is what is actually happening. The central bank sets a target range for one specific rate, the federal funds rate. That is what banks charge each other to lend reserves overnight. At the time of recording, that range is 3.5% to 3.75%, held steady at the July 2026 meeting. Notice what it does not set. Your mortgage rate, your credit card APR, the yield on your savings account. Not one of those is set by the central bank. Commercial banks set those themselves, competing against each other for your business. The central bank only moves the floor underneath them all. That is why the pass-through is so uneven. When the central bank cuts, the rate on your credit card tends to drift down slowly and grudgingly. When it raises, your borrowing costs move quickly. The bank's profit lives in that gap, and the gap is theirs to manage. So one institution sets the wholesale price of money. Thousands of others decide what you personally pay for it. Which raises an obvious question. What happens when one of those thousands gets into trouble? Commercial banks fail. That is a normal recurring feature of the system, not a freak accident. It is precisely why deposit insurance exists. In the United States, the FDIC covers $250,000 per depositor, per insured bank, per ownership category. If your bank goes under, your money is protected up to that limit. Read that backwards, and it tells you something blunt. Insurance exists because the thing being insured can genuinely be lost. Behind the insurance sits the central bank, playing a role with a very old name, lender of last resort. A perfectly healthy bank can still run short of cash on a given Tuesday. Its money is tied up in loans that mature over decades, while its deposits can walk out the door in an afternoon. When that gap opens up, the bank borrows from the central bank through the discount window. March 2023 was the recent reminder. Silicon Valley Bank looked fine, then failed in a matter of days, and the central bank moved in as the backstop for everyone else. Notice the direction of that relationship. In a crisis, money flows down from the central bank to the commercial bank. It never flows the other way. So can the central bank itself go under? Here is the fact I promised you at the start. The Federal Reserve has been running at a loss. Its net income has been negative on balance since September 2025. By early July 2026, the accumulated shortfall sat on its books as a deferred asset of roughly $236 billion, down from about $244 billion back in March. Sit with that number for a second. Any commercial bank carrying accumulated losses on that scale would have been seized, sold off over a weekend, and gone by Monday morning. The Federal Reserve recorded it and carried on. Its own statements are explicit that negative net income does not affect how it conducts monetary policy. The reserve banks that have already worked through their shortfall have sent about $6 billion to the Treasury this year. The reason is not a loophole. It is the entire design. A commercial bank needs capital because it can be forced to pay in a currency it cannot produce. A central bank issues the currency its own obligations are written in. That is the real dividing line between the two. One of them can run out of money. The other one makes it. So, one more time in a single sentence. A commercial bank is a private business that takes your deposits, lends against them and earns a profit, while a central bank is a public institution that banks those banks, sets the wholesale price of money, and issues the currency itself. Get that straight, and a lot of financial news stops sounding like noise. You will understand why a rate cut takes months to reach your credit card. You will understand why your deposit is insured and reserves are not. You will know which institution is actually holding your money tonight. Here is what I want to know from you. Before today, did you think you could open an account at the Federal Reserve? Tell me in the comments what surprised you most.